Hello, my name is Todd Glazer, and my fellow analysts are Radu Ionescu and Marcus Duhan. We want to thank you for viewing our analyst report on Amerisafe Incorporated as part of the Birkenroad Reports program. Amerisafe is a workers' compensation insurance provider for companies that operate in dangerous industries. The company is located in DeRidder, Louisiana. On March 19, 2013, the stock price closed at $34.61. The company's market cap is $618 million, and there are 18.25 million shares outstanding. The overall workers' compensation industry is a large and currently growing industry, as it grew 15% in 2012 to a total of $45 billion. There are an estimated 300 companies competing in this broad space. The hazardous workers' compensation market, where Amerisafe operates, is a smaller subset and is characterized by fewer and smaller competitors. Many of the large insurance companies consider this market to be too risky due to the potential for costly, high-severity claims. However, this higher risk requires a higher percentage of workers' wages to pay for the workers' compensation policies. So the companies that operate in these more hazardous markets are rewarded with higher policy rates. In the workers' compensation industry, companies are paid based on the number of hours worked by a policyholder's employees and the industry in which that policyholder operates. For example, logging, which requires more than 19% of payrolls, and construction, requiring 7%, are among the industries with the highest rates. As shown here in this pie chart, the majority of Amerisafe's revenues come from construction and trucking, followed by agriculture, oil and gas, and logging. More than 70% of Amerisafe's revenues come from markets that are very influenced by general economic performance. For this reason, Amerisafe has increased exposure and risk to economic downturns as unemployment rates fluctuate. Currently, as economic conditions in the U.S. improve, payrolls across the country are increasing, which is resulting in increased revenues for workers' compensation companies. In an industry where vast financial resources represent one of the greatest competitive advantages, the company faces serious external competition. Operating exclusively in hazardous workers' compensation insurance, Amerisafe is sensitive to economic factors as well as competitive and regulatory conditions, which can negatively impact its business. To determine Amerisafe's peer group, companies were chosen based exclusively on the specialty offering of workers' compensation insurance within hazardous industries. Factors such as market cap and geographic operating area were not taken into consideration. Within this subset, Amerisafe has few direct competitors. The peer analysis table provides a closer look at key statistics for Amerisafe and its peer group. Prior to paying off its long-term debt, Amerisafe historically maintained a relatively low debt-to-equity ratio, contributing to its high enterprise value to EBIT ratio. The company, because it did not pay a dividend until the first quarter of 2013 and has no long-term debt, currently has a higher than average level of cash, up to 35 times greater than Tower Group holds and 6 times greater than National and Interstate. We believe that Amerisafe's surplus cash and zero long-term debt makes it an attractive acquisition target. Increasing stock price is a result of various factors. Improving macroeconomic conditions offer a great foundation for future growth. Low interest rates for at least the next 2 years, along with a projected steady increase in GDP of 3%, will drive top-line revenue. Amerisafe has been applying efficient operational practices and cost structure. In an industry with narrow profit margins, Amerisafe has developed a sustainable competitive advantage that focuses on reducing loss costs through intensive safety advisory services. Last but not least, seasonality has been playing an important role in Amerisafe's opportunities and financial performance. The insurance industry is currently in a hardening market, which is characterized by increasing policy premiums and decreasing competition. These conditions are very favorable to Amerisafe's bottom line. Our team has included all of these factors in the financial model, which we think will generate additional growth in the next 12 months. Steady long-term rates will have mixed implications on Amerisafe's operating and investing activities. The industries that comprise the majority of Amerisafe's written policies are all positively impacted by lower interest rates. However, the projected low interest rates will depress investment returns, which will result in increased pressure on underwriting margins. Amerisafe's top-line revenue moves in line with macroeconomic indicators, such as housing starts, GDP, and oil prices. The fourth quarter of 2012 was one of the company's best ever because the economy is accelerating its growth. With its cash surplus and positive future expectations, Amerisafe's management team recently announced recurring quarterly dividends of 8 cents per share. This decision is also the result of the following resolutions: the current favorable national tax policy toward dividend income, a consistent growth in gross premiums written and book value, and adequate cash resources to maintain the A rating from AM Best. The Amerisafe Safety Services Division offers client safety management services and safety training programs through online, on-site, and customized courses. For valuation, we considered the following methods: price to book value, discounted cash flow using net income, and price to earnings. After a thorough analysis of several valuation methods, we decided to solely rely on the discounted cash flow of net income to project a 12-month target price of $36. Our team agreed to eliminate the price to book value and price to earnings methods from the forecast because the high amount of available cash and no long-term debt that would hamper the accuracy of these techniques. In developing the revenue model, our team analyzed GDP, housing starts, and the cyclical nature of the workers' compensation market. Amerisafe's biggest risk is the potential for randomly occurring, very expensive insurance claims. The company has implemented safety and training programs intended to mitigate this risk. However, there are inherent dangers in the construction, manufacturing, trucking, oil and gas, and agricultural industries. Amerisafe safety programs have effectively mitigated this risk. Amerisafe does not currently have any debt on its balance sheet, and this puts the company in a strong financial position relative to its peer group. Additionally, Amerisafe has ample cash on hand, allowing it to issue dividends for the first time and fund operations without the need for outside credit. Concurrent with the United States GDP growth forecasts, the Federal Reserve recently announced low interest rates for at least the next 2 years, which we assume will boost the overall economic expansion. Amerisafe does, however, have increased interest rate risk due to historically low interest rates in the bond market. Regulations in the workers' compensation insurance industry represent a constant risk for Amerisafe. Many states, for example, limit the attrition rate, or the non-renewal of policies, in order to protect policyholders. This situation could negatively impact Amerisafe's bottom line if the company is forced to work in an unfavorable market. However, a state's insurance department can approve exceptions to this regulation. Amerisafe came out of the recession as a strong competitor that has regularly outperformed its peers, and we believe will continue to deliver favorable results in the upcoming years. The favorable macroeconomic climate will support the company's future growth prospects, a situation clearly reflected in our revenue projections. Our team believes Amerisafe is a strong candidate for investors who are looking at long-term returns and steady dividends. As of March 19, 2013, Amerisafe's stock price was $34.61. Our 12-month target price is $36, and we have attached a rating of Market Perform. The Birken Road reports are produced solely as a part of an educational program at Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.